Hi, and welcome to HC Andersen Capital. My name is Olivier, and I'm joined here by Philip from the research team. And today we wanted to go through a forum thread at forum.inderes.dk where we go over the corporate earnings that we've had so far. And Philip wrote a very nice post on the bank sector. So, Philip, how has the earnings been so far in the bank sector?
Sure, and thanks for having me, Olivier. The bank sector earnings were quite interesting and largely were positive surprises. We saw all of the Wall Street banks have reported now, and we saw largely earnings beats on the earnings per share. And we also saw larger than expected revenues at most of the big banks, particularly from net interest incomes, as the banks were earning larger revenues on their loan portfolios under the higher interest rates environment. And another part of the banking story was looking at the provisions for bad debts. And here we saw all of the big banks increase their provisions, with Morgan Stanley increasing their provisions for bad debts as much as 4 times. And this sends a signal that potentially the banks are expecting higher rates of default later in the year, as corporate earnings maybe are impacted by this potential recession. So overall, the earnings story was mixed. We saw largely positive results for the first quarter of 2023, but potentially some storm clouds on the horizon for later in the year.
And to elaborate a bit, how does this look in regard to the markets?
Sure, good question. So initially, markets were boosted by these bank earnings, particularly as fears of a broader banking crisis were reduced. But the follow-on effect is that higher corporate earnings can lead to higher interest rates, and also the reduced fear of the banking crisis led to interest rates increasing, and that has put some downwards pressure on markets.
Thank you. So we also covered some of the in the thread. We also covered some of the tech sector earnings. So how has that looked so far? We had the earnings from the big tech companies. What is your take on that?
Sure. So last week we got earnings from Netflix and Tesla, which are of course two highly followed stocks. So to dig a little deeper into Netflix first, which was the first of these to report, we got mixed earnings from Netflix. We saw a slight miss on the revenue side. Netflix reported revenues of $8.16 billion against expectations of $8.18 billion. But on the earnings per share side, they beat expectations. They realized earnings per share of $2.88 against expectations of $2.86. So a slight beat on the earnings per share side. But what was interesting in the Netflix story wasn't about the earnings themselves, but more about the subscriber growth. And here we saw a big miss, with Netflix paid subscribers growing by 1.75 million for the quarter against expectations of 2.3 million for the quarter. And it's really this slowing in the rate of change that spooked investors. And the stock was sent down 13% in the post-market after Netflix reported. However, since then, the stock did recover somewhat, because Netflix announced that they're going to start clamping down on their shared accounts. So as of Q2 this year, Netflix is going to start clamping down on shared accounts, and investors hope that this can increase the number of paid users.
Do you expect that now that they're cracking down on the password sharing, account sharing, do you think that will make up for the miss in the growth of actual subscribers?
I think it's a really difficult question to answer, because we don't know if all of the shared users will come back and generate 2 accounts, or if the shared accounts are people who only have a willingness to pay 50% of the price of Netflix, and the clampdown will actually reduce the total number of accounts. I think markets are expecting that it will increase the number of paid subscribers, and I would probably tend to agree, but I think we're really going to have to wait and see in the next quarterly earnings how that's developing.
So still uncertain times ahead for Netflix and the subscriber growth. We'll see in Q2 how it develops. But you also mentioned Tesla. How were their earnings?
Yeah, Tesla, again, much loved stock. and we saw Tesla miss on their earnings slightly. So it was a slight miss, but they missed on the revenue and earnings per share. The revenue came in at $23.33 billion against expectations of $23.35 billion, and earnings per share came in at 85 cents per share against expectations of 86 cents per share. So not huge misses, but misses regardless. But again, the big story for Tesla was not the earnings themselves, but they came out in the morning before they reported earnings with further price cuts. And this has been an ongoing story for the company, where they're cutting the prices of their car, eating into their gross margins in order to keep production at max capacity and really eat into the market share. And Tesla have the gross margins to do this. They have industry-leading margins of over 20%. And actually for this quarter, they fell just below 20% to 19.3%, but still significantly greater than the likes of Ford or General Motors, who are down in the 5 to 6% level. So Tesla's stock was actually sold off quite significantly on the earnings miss. And again, it wasn't necessarily the earnings themselves, but investors possibly not agreeing with Tesla that the price cuts is the best direction of travel.
It'll be interesting to see how they might recover and hit the next expectations in Q2. Thank you very much, Philip, and everyone out there. Remember that you can read our thread. You're welcome to also join the discussion, and we are going to cover both the tech sector, the medical sector, almost all sectors with the earnings. And of course, you're welcome to talk about U.S. stocks, but also the Danish market and much more. So we hope to see you at forum.inderes.dk, and thank you again, Philip.